everyone. I'm Jessica Leewen, Director of Marketing at Upside Avenue. Thank you for joining us for Upside Insights, where we check with investment experts and get their opinions on how we can live our upside. I'm here today with Jim Denholm, founder and CEO of IronBridge Private Wealth. Welcome, Jim. Thanks for joining us again. How are you doing?
Hi, Jessica. Thanks for having me back.
Good. Hey, how's the pandemic been affecting your golf game?
I'm glad you asked that. It's been interesting to have a hobby. One of my hobbies is golf, and it's been pretty fortunate that it is definitely a game that is conducive to social distancing and being outside. So it's been pretty fortunate to have one of my favorite hobbies be so compatible with this strange environment.
That's great. That's fantastic to hear. So we recently had you as a guest speaker on our educational webinar series. And we were talking about investing during a volatile time. And the topic of the election came up. It's a very big issue on everyone's minds right now. So I'd like to ask you, depending on who gets elected, how is that going to affect the markets?
Well, thank you for the question. And this is a very common discussion that we're having with our clients and our prospects. We're getting the same question from friends, from partners. It is definitely on the top of everybody's mind. And there's a couple different ways that we think about it. One is it seems like different policies should affect the market differently. It is very logical to think that if there's an increase in regulation or a decrease in regulation, that's going to have a dramatic outcome on the overall market, or more specifically, different segments of the market or different industries. And so our approach has been, let's go back and look to see how these predictions have done in the past. So before I answer your question directly, maybe give you a little bit of context on how we think about things. So the last two presidents, President Obama and President Trump, really couldn't be any different in a lot of ways, but we'll focus this discussion on the markets. And specifically, I think the greatest contrast is with financials, with banks, and with the energy sector. These are vastly polar opposite policies that were discussed prior to the election and actually implemented post-election. So during Obama, the Obama administrations, the 8 years, there was the Dodd-Frank bill. There was highly increased regulation on the banking sector. There's very much increased regulation on the energy sector. And sort of to no one's surprise, financials and energy, when we look at the various industries in the S&P 500, they did the worst. Those were the two bottom performing sectors in the market. Trump comes along and couldn't have more different approach. It was going to scale back regulation on the banks, scale back regulation on the energy companies. And not only did he talk about it in the lead up to the 2016 election, he actually made pretty dramatic policy implementations. The irony, and as a result, a lot of people were predicting that financials and energy would perform very well under a Trump administration, in contrast to the Obama years. In actuality, the two worst performing sectors under the Trump administration were financials and energy. They actually performed better under Obama than they did under Trump. Energy companies averaged a 5% return under Obama. Under Trump, they averaged a negative 16% annual return under Trump. Despite, like I say, policies that were not only discussed, but were actually implemented. So in some ways, we need to question what is the real effect of these policies when it comes to markets. Our approach is that we need to look at what is actually driving market prices. I think we as the electorate want to place a little bit higher emphasis on the importance of these policies when it comes to markets. So right now, in our view, the biggest influence on market prices is the Federal Reserve.
Oh, so it's not based on the election.
We don't necessarily think that the election is going to have much influence on market prices. That may come as a shock to Trump supporters who think that the market might crash under Biden. That might come to a shock to Biden supporters who think the economy and markets will be terrible under a second Trump presidency. I tend to think that it's not going to matter. The biggest influence on the markets right now is simply the massive amount of liquidity that the Federal Reserve is pumping into the financial system. And to put some context around it, in the 10 years following the financial crisis, the Fed printed a little bit right at $4 trillion that they basically created in a digital manner, that they put that money into the financial system. That resulted in one of the longest bull markets and one of the biggest bull markets in history. Following COVID, since April, the Fed has printed $3 trillion. It is a reason why people are surprised that the market has been as strong as it has been over the last few months. It's one of the reasons why we personally think that the trend is higher and that the bias is likely higher. And the Fed is scheduled, they've announced that they're going to print another 3 to 4 trillion.
Wow.
So the bigger issue with the presidency is who is going to be the Federal Reserve Chair.
It's so interesting. So is there anything following the election that could affect anything? Like, what is there?
So some of the biggest things that are different is Biden has come out and pretty clearly said he wants to raise taxes, specifically corporate taxes and taxes on higher income earners above 400,000. We think that there is probably a couple different potential outcomes from that. Some research that we've seen done by various firms suggests that if Biden implemented his tax increase recommendations as he has published thus far in kind of early October, that it would result in about an 8% valuation hit to the S&P 500. The valuations at this point, with the Fed printing so much money, valuations are not really a factor in the markets right now. We saw a 10% decline in the market in September. And so an 8% valuation hit to S&P 500 companies is really more of a normal 10 to 20% pullback that the market experiences every 12 to 18 months. So the potential tax implications, I think, are a little bit overemphasized by people opposing Biden, and maybe I don't know that they're going to have quite a big of an impact on the overall market performance as people think. Now, the other thing that could be happening is with potential tax changes, there could be financial planning steps that individuals might need to take as far as when to realize certain capital gains, when to make certain charitable deductions that might be favorable under the current tax law versus the projected tax law. If there was a massive blue wave and Biden won handily and the Congress decisively switched over to Democrats, maybe a massive tax bill is passed, in mid 2021. Historically, those don't come into effect until the following year. So, it's very rare that those are retroactive. Unless they're passed very, very, very early on in the calendar year, with the inauguration being late January, all the mechanics that would need to happen from a legislative standpoint to get things passed, it's probably going to be second quarter, if not third quarter, before there might be any kind of tax legislation that would change, which would most likely mean that the tax implications would be in effect for 2022, which probably gives an investor, 13 or 14 months from the election to identify what needs to happen from a financial planning standpoint and make any appropriate steps. So I would not be making any financial planning decisions from now until year end based on the potential outcome of the election. And I also wouldn't be making dramatic shifts in your investment strategy between now and the election, because frankly, I don't think it's really going to matter that much.
That's wise advice, Jim. Definitely. So it definitely sounds like we have some time. We don't need to panic. Even no matter how the election plays out, that it really is the Fed that affects the markets.
Right. And that's may not be what we want to have happen. It may not be what we think should happen. It may not make a lot of sense to a casual observer of the markets. It's our job. We take steps to grow our clients' portfolio values, but also protect them. And we've gotten a lot of questions. Should we de-risk before the election? Because what if there's a Bush v. Gore on steroids? There is the potential for things to get fairly sloppy after the election if the rhetoric leading up to the election is any guide. We tend to want to rely on a process. And to give you an example, so we are not advising that clients go in and take steps to necessarily de-risk their portfolio. Our portfolios, for example, we raised a fair amount of cash, about 30% cash in early September, based on our proprietary signals. This week, we've started to get signals to put that cash back to work. So our expectation, and this should be, I think, is a good rule of thumb when you get in a volatile environment like we're in, is if you make an investment or you make a purchase, especially with highly liquid investments like stocks or index funds, you don't have to hold it for 10 years. It's okay to sell, and it's okay to have cash in your portfolio. It's okay to move and buy a stock or buy an index fund and not own it very long as you have a process around what those decisions are. So I would very much highly advise that clients do not make, and investors do not make, emotional decisions right now out of either fear for what the election may bring or optimism about what the election may bring. It is a recipe for an investment mistake. And instead create and implement a very disciplined process. And if you have that process in place, the election doesn't matter, because there's always going to be risk in the markets. There's always going to be the potential for markets to go higher or go lower. And I think that the Fed is going to be driving things. I think the bias right now is higher. And if there's an extended conflict post-election like Bush versus Gore on steroids, maybe the market pauses a little bit and has a little bit of volatility, but I frankly would be relatively surprised if we saw anything more than 20% declines, give or take. And the bias is probably higher.
Perfect. Well, thank you, Jim, for taking this time to, reassure all of us that, we can stay calm and everything's going to be okay. And thank you for sharing your expertise with us.
Well, thanks for having me back on. I really appreciate it. Nice to see you again.
Yes, absolutely. Anytime. We are happy to have you. And just a reminder to everyone to go out and vote. If you enjoy receiving information in this format from us, click that button to follow us on social media and YouTube. So again, everyone, thank you for joining us, and stay safe.